All right, you've got this.
Hello, everybody. Can you all hear me? Awesome. All right. Let's see here. Thumbs up. Good morning to everybody. So wanted to reach out to you guys and basically go over rates, real estate, and recession. So what I'm going to do is go through a few slides here and give you a little bit of history and show you what the impact of inflation is to real estate, rates, and the recession. So if you have questions, go ahead and put them in the chat and I'll try and answer those along the way. And if I don't answer them at the beginning here or throughout the webinar, then I will answer them at the end. So let's start with inflation. So inflation has a direct impact on mortgage rates, and the bond market absolutely hates inflation. So what is inflation? Let's talk about what the definition of inflation is. And it's basically, in the most simplistic form, it is too many dollars chasing too few goods. And we've actually seen that in the real estate market over the last couple of years. So we've had low inventory and a lot of money, a lot of people actually trying to get too few properties. And so what that's done to property values has increased those property values. And that's how we get to inflation. So let's go, I'll give you one more example of how inflation works. So let's say that you were the lender, you were the mortgage lender, and you were giving $400,000 to somebody to buy a house. And the most simplistic way of explaining this is basically your payment that you receive every month was $2,000. So you got every month, you got $2,000. And after you get those $2,000, you go to the grocery store and you get your list of 15 or 20 items. You go there, you go to the store, you buy all the things on your list, and you're good to go. So you do that month in, month out, and keep on going. But in a year, there's 10% inflation. And so you're still getting that $4,000, but you're going to the grocery store, and instead of getting everything on your list, you're only getting maybe 75 or 80% of the things on your list. Well, that's because the prices of those goods and services have gone up over time, and that $2,000 that you're getting from a payment perspective, for the $400,000 that you lent out, is not going as far to buy all those goods and services because the prices have gone up on those items. So the next time you lend out that $400,000, you're going to charge $2,500 or $2,600 so that when you do go to the grocery store, you actually have enough money to buy everything on your list. So that's how inflation causes mortgage rates to go up over time. So the Federal Reserve is the board that actually manages kind of how the economy flows. And so they manage the inflation. Jerome Powell and the rest of the people on the board, they haven't been doing a good job of it as of late. But in fact, Jerome Powell said the other day, about a month ago, we're even still learning about inflation, which was not a very good confidence booster in our Federal Reserve System at this point in time. Most of the people on the Federal Reserve, they actually have never had jobs out in the real job world. They actually have either been in the Federal Reserve System or have worked in academia. And so they don't have that real world experience. So they're trying to kind of do this, not with the kind of experience that most of the people like you and I might have out on the street with, filling up our cars with gas or going to the grocery store with higher interest rates. So what they're trying to do is they increase the Fed funds rate. The Fed funds rate is what the banks borrow money from the Federal Reserve System on an overnight basis. And so those federal funds rate, they don't necessarily increase mortgage rates. So note that when the Fed increases mortgage rates by when the Fed increases the Fed funds rate, that's not necessarily increasing mortgage rates, okay? The products that usually have an impact when the Fed raises the Fed funds rate are going to be short-term rates. So maybe credit card rates, HELOCs, car loans, but more importantly, it's commercial rates. And those commercial rates are rates that bigger companies use to borrow money to grow their business. And so as those interest rates go up, those companies have to think twice about actually borrowing money because of the higher cost of those rates. And so the other piece of it is that if interest rates are going up, the Fed is actually trying to slow down the economy, and you're trying to grow your business, you're growing your business into a market that may possibly be slowing. And so that's what the Fed is trying to do, is to slow down the economy. So the next thing is that raising those interest rates actually gives you, the consumer, the wanting to save more money. So they're encouraging people to save money, to put it in their savings accounts. So those savings accounts that were giving you any interest over the last couple of years, you may start to see those actually go up a little bit, and you'll start to save more money, and you'll actually earn a little bit of interest. But that, again, is the Fed trying to slow down the flow of money and take that money out of the economy and put it into your savings account and slow it down. So the risk of this is actually slowing us down and bringing us into a recession. And so there's a lot of talk about that at this point in time. Before we go any further, let's talk about a little bit, just some positive things out there in the market, and how the purchase activity is still very, very strong, and there's still a lot of units that are going to be transacted this year across the country. So last year, as far as the number of units that were actually transacted in the real estate business, were about 6.1 million units. Now, over the past 10 years, we've seen it range right around 5 to 5.5 million units, maybe up to 5.6 million units. And this year, we're expected to transact about 5.9 million units. So very, very strong activity. We know that the numbers as far as properties that are out there that are for sale is still very, very low, but we're still going to do a lot of business in 2022, and in 2023 it's still saying that we're going to do more. In fact, the Mortgage Bankers Association, they are basically predicting that we're going to do 2.1 billion in mortgage transactions. So that's just the loan amounts for those purchase transactions. We're going to do about 2.1 billion, which is the fourth best in 16 years. And if you take out the last 2 years, it's going to be the second best in 16 years. So we're still in a very, very strong business as far as a number of units that are going to be transacted. So let me give you a little bit of history on inflation and how that impacts interest rates. So in the 80s, the Fed chairman was Burns and Volcker. So those were the two chairmen that were kind of managing the Federal Reserve System. And during that time frame, they had inflation go from 7 to 14%. Mortgage rates went from 12 to 18%, so way higher than what we're dealing with today. And the Fed funds rate, so what they did to actually slow down the inflation was raise the Fed funds rate from 11 to 20%. And the response from those increases to inflation, it brought inflation back down from 14 to 5%. And mortgage rates actually went from 18 down to 12%. So remember, this is at different times back in the 80s, but it brought down, the goal was to bring down inflation. It brought down inflation, which brought down the mortgage interest rates. The consequences of those changes were basically putting us into a recession. And so the S&P was down by 30%. Well, in the 90s, it's the same thing. Alan Greenspan was the chairman, and we had inflation going from 1.75 up to 3.5%. And interest rates for mortgages went from 7 up to 8.5%. And in order to combat that inflation and the higher mortgage rates, the Fed increased the Fed funds rate from 4.75 to 6.5%. And then what happened? Inflation went from 3.5 down to 1% after they made those changes. And mortgage rates followed suit. It went from 8.5% down to 5.5%. And then the S&P, because of those, the high inflation and bringing down the inflation and slowing down the economy, it actually had a negative impact on the S&P, and it was down by 50% and also put us into a recession at that point in time. And I'll go through some of these things a little bit later on. And right now we've got Jerome Powell, who is running the Federal Reserve, and we're dealing with inflation that's gone from 1.5% up to 9.1%. So the most recent reading of inflation, which was last month, was at 9.1%. That has sent mortgage rates over that period of time, a very short period of time, from 2.5% up to even above 6%. I have 5.5% in here, but they've gone over 6%. They're now in the 5s, but there are some products that are pushing it into the 6s. But basically, the rates have gone up. By the end of this year, we're going to see the Fed funds rate go up to 3%. So it was at 0, and now they're increasing it. They're meeting today, actually, and they're going to come out with some increases tomorrow. But basically, it's going to get our Fed funds rate up to 3%. So based on past history, inflation should drop. So it should go from 9.1%. It's actually going to show you on the next slide, but it's going to increase. And then as the economy slows, the inflation will start to come down, and mortgage rates should do the same thing. So if history repeats itself, we're going to be put into a recession, and some people think that we might already be in a recession right now. And you've already seen stocks kind of slide a little bit. So the stock market has gone down, and we've seen some signs of some slowing. I'll go over that in just a little bit here as well. So you're going to ask me, well, when is inflation going to peak? This is a graph of the CPI. It's a consumer price index, and this is one measure of inflation. So the most recent inflation numbers that we have, it was at 9.1%, and basically it measures it over a 12-month period of time. This graph actually shows a 15-month period, okay? And the 15-month period, these items here in yellow, these numbers here in yellow are actually the most recent numbers to come off. And those numbers were relatively high compared to actually the next 3 months that are going to come off. And so although inflation is super high right now, it's going to go higher over the next 3 months because we're going to be replacing these lower numbers in this red box. So July, August, and September of 2021 will be replaced with inflation numbers, which are going to be actually higher because we know that prices at the gas pump, at the grocery store are still very, very high. So those numbers are going to be higher. They're going to replace these lower numbers. So our feeling is that inflation is probably going to peak at the end of October, the end of September and the beginning of October. And the Fed is, so in conjunction with all of that, the inflation will peak in late September, early October. The Fed is going to increase tomorrow by 3/4 of a point. And then again in September by another 1/2 to 3/4, which is slowing down the economy even further. And that will bring prices down because of the lack of demand. Remember that the inflation is too many dollars chasing after too few goods. Well, what they're trying to do is bring the dollars down and take it out of the supply and actually increase the goods that are out there. And so there's going to be lower prices because there's not going to be as much demand. In addition to that, we have China that has they import a lot of goods and services to the States. Now, they've most recently been in a COVID lockdown for the last couple of months, and they've just started to release a lot of goods and services. They have hundreds of ships that have 10 to 12,000 containers. So those containers are the semis that are on the back of the semi trucks. They have 10 to 12,000 containers on these ships that have been sitting over there waiting to be released because of the COVID lockdown, and they've finally started to release those items. So in addition to kind of the Fed slowing down the economy with a higher Fed funds rate, we're going to start to see a lot of goods and services show up in our ports and go into the stores. And by that time, we're going to have a lot of inventory and not enough goods, and that's going to bring down prices. So let me give you a little bit more data on how this impacts mortgage rates. So in this slide, every time the Fed has increased the Fed funds rate, the mortgage rates have gone down. And I know this slide is a little bit small for you to read, but at the end of the day, these red arrows are the mortgage rates coming down after the Fed hikes the interest rates. And so what you're seeing right now is over the past couple of last month, you've actually started to see interest rates come down because the Fed they're increasing the Fed funds rate, they're slowing down the economy, and that's what happens to mortgage rates at the same time they come down. And so you've seen mortgage rates actually relax a little bit over the past, especially 2 weeks, but over the past month, you've seen them decline a little bit. So that's the Fed, what happens to mortgage rates. Now, even the president commented yesterday that basically he doesn't think that we're going to go into a recession because we're at full employment and it's a very strong economy. Now, the way that we see it is that when you are at full employment or low unemployment, so these numbers, the white line represents the unemployment numbers. And so here's where we are today at the end of the graph. We're at full employment, just above 3% unemployment rate. And every time, so the dark blue vertical lines here are recessions. And so every time you're at full employment, you actually start to see a recession come right after full employment. And that's partly because you're at full employment, the economy is rolling, and actually prices are going up. You're starting to see inflation. And so the Fed starts to slow down the economy. to get it back in line with everything. And you then start to see companies actually stop hiring or start to lay off people. And most recently in the news, you've seen Tesla, Microsoft, Amazon, all starting to slow their hiring down quite a bit. And so they're either laying off people or they're slowing down their pace of the hiring. So the other thing that we measure is to kind of see that a recession is coming is GDP. GDP is the gross domestic product, and that measures the growth or contraction of our economy. In the first quarter, it has been kind of solidified, it's been adjusted that we were down 1.6% in the GDP. So that meant we actually contracted by 1.6%. We didn't grow, we went backwards by 1.6%. The second quarter numbers actually come out later this week. They will be adjusted and probably adjusted again after that, but they are predicting that there is going to be another 1.6% contraction or negative number on the GDP. So that is just another sign that a recession or the economy is actually slowing. In fact, yesterday, these are headlines from the Wall Street Journal. Basically, Walmart cuts profit outlook. It lowers their prices to move goods. And so even this morning, I've heard numbers that Walmart is cutting their prices on their goods by up to 65%. And so they'll probably see some layoffs because of the profit numbers are going down at Walmart as well. And then just another sign that we're going to be moving into a recession is investors. So that is kind of Wall Street is basically saying that they're going to bet that the Fed is actually going to cut interest rates in the first 6 months of 2023. So what we're seeing is the increase of the Fed funds rate through the end of the year, and then they're going to slow down the economy so much that it's going to be put into a recession. And once it's in a recession, they're going to have to adjust and take it out of a recession and start to kickstart the economy a little bit further. So those are kind of current market trends like this week of those items that are happening. Mortgage rates. So I'm kind of this again solidifies where I'm going with this presentation is that mortgage rates and recessions, generally interest rates go down. So most recently in 2020, we saw the interest rates go down from 3.75 down to even lower than 2.75%. In 2008, we saw the interest rates go down from 6 to 4.875 during the recession. In 2002, we actually saw interest rates go down during the recession from 7.375 to 6.75. And then back again from 11 to 8.75, 18 to 13%, and 16 to 11.75%. So we're not in bad shape at our interest rates at 5.5%. So we're still really good on the interest rates, but they will come down in the fourth quarter of this year. So what happens to the housing market through recessions? The housing market generally does pretty well during those recessions. So again, these vertical numbers with vertical block lines here of dark blue or black, you see the housing market continues to stay strong during the recessions. There was one period of time in 2008 where that was not the case. And I think that goes to kind of the mortgage rates or mortgage products that we were actually putting out were not great products. And so that's where we saw a lot of too many people owning houses with no money down and no income documentation to justify them buying houses. And so we saw kind of a drop in that time frame in 2008 when we were in a recession. So this week, or actually last week, Zillow came out and basically said that they will see a 7.8% appreciation over the next 12 months. So that's still very, very strong. We think that it's going to be somewhere between the mid to high single digits. So 7.8% would be on the high side of where we see the appreciation, but there's still a very, very strong demand for housing, and we think that it will continue to stay strong. There's a lot of contradiction to this in the market that basically says that we're going to have a 20 to 30% drop. And what I don't want you to necessarily do is believe the media. And so when I say that, I'm trying to put in here in this slide, basically, if you believe the media, so CNBC, these are all headlines from CNBC. And if you would have waited to buy a house for $300,000 in 2015 because you're listening to CNBC basically say there's a bubble larger than 2006, and then they continue to go on in 2016, 17, 18, 19, and 21, that they kept on saying that we're in a housing boom and it's going to shift, and we're going to have a housing crash. Well, if you would have listened to all that in 2015 and did not buy a house, you would have missed out on about $222,000 worth of equity in your house. And so that is what I'm trying to tell you, is basically make sure that you communicate with your customers what you think the market is doing and why. So have information like these numbers that I'm going over that to back up some of your data and show them why you think that there's not going to be a 20 or 30% decrease in housing values. One other item here is that housing formations continue to be strong. So there was a little bit of a up and down just because of the pandemic over the last couple of years. But the reality of it is that it's been very, very strong over the past 15 years. And right now there's about 1.4 million people that are actually that are new housing formations. Okay, so that is, you know, somebody that's living at home with their parents is actually going to go and buy or rent a new house. It is couples that are splitting. So maybe there's a divorce going on. So one person stays in the house and actually goes out and goes into another house. So there's a lot of formation of houses being formed, and it's still right around 1.4 million units. We think that the market is actually short by about 1.5 million units. And so there's 1.4 million that are shopping, and there's about 1.4 million or 1.5 that are actually were short of inventory on those houses. So let me go into detail about why I think there's a shortage and how that will keep the prices strong on real estate. So we've talked about housing starts are projected to be 1.7 new housing starts in this year. And just every year, this is just an annual number. There's about 100,000 units that they're destroyed, they're not finished, they're not done. So that leaves us at about 1.6 million of new supply. This is new housing. This is not existing housing. This is new housing. Okay. And so the demand for this new housing is that formation of 1.4 million units. So if you take those two numbers, the new supply of 1.6 and the formations of 1.4 units, there's a actual surplus of about 200,000 homes that are available. So that would mean that there's enough housing out there for everybody, and we will start to gain on the the negative units that we're still short. But when you look at the real numbers, the actual completed numbers, so these are starts, the 1.7, the actual number of completed houses is 1.3. You take out the 100,000 that are usually destroyed, that leaves your supply at 1.2 million, and that leaves you 200,000 short. So every year we're still short by 200,000 units. This again will keep the prices of houses going higher and support Zillow's 7.8% appreciation over the next year. In addition to the new housing, the existing is still at a record low. So we've seen inventory jump up just a little bit, but over the years, it is still a very, very low inventory. Now, it always happens at this time of the year that you start to see the inventory go lower. So you'll start to see the inventory jump up over the next few months. It's just part of how we flow in the mortgage business and the real estate business. And so you'll start to see the inventory pick up, and that will soften prices a little bit. But again, the demand is still very, very strong. So let's look at the numbers of the existing homes. And this data is a little bit dated, but it still gives you the picture that I'm kind of painting for the strong real estate numbers. So in inventory, you have about 1.1 million in inventory. What that doesn't take into consideration is there's half of those, or 644,000 units, that are actually under contract. So as a real estate agent, you're not going to go out and show properties that are under contract. So why would you sell them if they were under, or why would you go out and show them if they were under contract? Because they're already sold to somebody. So that does not take into consideration those houses. So the actual inventory is about 516 of existing homes on the market. So this is still very, very low, and it confirms kind of what I've been saying, that it is a very strong market, and it's at one of the lowest levels that we've seen in a long time. And so this will continue to put pressure on housing prices to go up over time. I'm going to switch gears just real quickly here and talk about affordability. So this is another thing that the media is kind of, there's propaganda out there that it's super hard to, with the increased housing prices and increased rates. So let's take a look at the numbers here. In 2021, we had a house, let's just say at $400,000, and the interest rate at 3.5%. That payment was just under $1,800 at $1,796. And the household income was at $9,000 per month. So that would be individual or a couple. It's the whole household income qualifying for that type of loan was at $9,000. Well, this year in 2022, the housing prices went up by 18%. So we went from $400,000 to $472,000, which was an increase of that 18%. The mortgage rates went up from 3.5% to around 6%. So call it 5.5% to 6% right now. Well, that impact on your monthly mortgage payment was $1,000, $1,034. So that increased your payment by $1,000. Now, what the media is not telling you is that the household income actually went up by 8%. So that 8% was $720 per month increase in the household income. So the delta between those still, while it's still negative, there's a delta of $300 per month there. Now, what I think is actually driving this further is the slowdown in the purchases is the increase in inflation of those other goods and services. So gas, groceries, other services that you're buying, they're all going up in price. So instead of it being $1,000 a month, it's $1,300 or $1,400, maybe even more than that, $1,500 difference in your monthly outgo. So once the Fed increases the Fed funds rate, the economy starts to slow down, prices will actually come down as a result of that. And so this number, the inflation numbers will start to shrink a little bit, and your household income is actually projected to go up by another 8% next year. And so you'll start to see some evening out with the interest rates actually the mortgage rates coming down, and your household income going up, and the affordability will be there going forward. So it's difficult right now to afford a house at these higher prices with the inflation, but you'll start to see the affordability get better, and the affordability issue will be mitigated. The housing forecast for the next 12 months, and I already kind of referenced Zillow in here, and so this kind of fits in with what Zillow is saying. But what I want to show you is it's still better to buy real estate than it is to rent. Rents are going to go up on new rentals by 14%. So new applications, if you're switching out a tenant, they're going to go up by 14%. And this is kind of across the country here. On existing rentals, they're going to go up by about 8%. So if you have somebody in there already and they're going to renew, that's going to go up by 8%. The real estate forecast, like I already said before, mid to single high digit appreciation over the next 12 months, supported by Zillow at 7.8% over that same period of time. So when you look at these things and you take it from a very simplistic view, let's just say that you bought a house for $100,000 and you put 10% down for the down payment on that house. So that was $10,000 that you put down, and there was actually just a modest 4% appreciation over the 12-month period of time. That's a $4,000 profit. Your house would now be worth $104,000. And your $10,000 investment would return you a 40% return on your money. And that is just the 4% appreciation. So even if interest rates are at 5.5% to 6%, you're still going to have appreciation of around 5.5% to 7-8% in your house. Okay, so you're still going to see those numbers increase on your investment in a house. Whereas on your rentals, in fact, let's look at the numbers here. I have a scenario basically that shows the rent versus buy scenario. And so if you purchased a house today, and I have a 5.875 interest rate on this particular example, your monthly payment with taxes and insurance would be right around $6,200. That's these black bars going across the way here. Now, this is a little bit different in other states. California is the example that I'm showing here. The examples in different states, the rent's actually probably pretty close, but there wouldn't be a negative cash flow. And so, in fact, this would tell you today, like from a cash flow perspective, it is better to rent based on your cash flow every month. Okay, but over time, the rents are going to go up, and it's going to be pretty close over the next 9 or 10 years to what your actual mortgage payment will be, because it's a 30-year fixed rate mortgage. the payment stays the same over time. So you don't ever have inflation on a 30-year fixed rate mortgage, right? Well, even with the negative cash flow of renting, you're going to have appreciation gain of, and these numbers say 6.5% over that 9-year period of time, which would be about $690,000 in appreciation that you're going to see. In addition to that $690,000 of appreciation that you see, you're going to have an amortization gain. Amortization gain is actually over 10 years, you're going to pay down your mortgage over that period of time. And over 10 years, you're going to see your mortgage go down by about $110,000. So when you look at these numbers over 9 years, the delta is you'll be better off. Your financial position will be better off by $616,000. So almost $617,000 better off by purchasing a house. So with all of these numbers and kind of showing that, yes, we're probably going to go into a recession. We're most likely going to see a strong real estate market continue, and we're going to see mortgage rates drop. We're not in bad shape here. And so we will see the market to continue to get better. There's still inventory to be had out there. There will still be units to be sold, and we will be in a much better position. So that concludes kind of my presentation. Hopefully that was informative to you. And let's see if you have any questions out here in the chat room. So let's see here. Good morning. Let's see here. And there's always the option to refinance your rate. Yes. So in addition to kind of, if you bought now with the higher interest rates, it is still a good time to buy based on appreciation of your property and your investment. But in 6 months, we think that interest rates are going to be down. And if you do refinance your mortgage at that point in time, then the cash flow difference between what we're looking at here is going to be, the cash flow is going to be much better positioned. So it's going to be a less negative number at that point in time, and you'll be in a much better financial position. So yeah, thank you for pointing that out. It does not look like there's any other questions in there. So if that concludes everything, and I appreciate you joining the webinar. And if you would please, actually, there's 2 questions at the end of this. If you would actually reach out and basically tell me the answer to those 2 questions, I would appreciate it, so that I can know if this is something that you want me to continue to do over the coming months. So thanks a lot for attending, and we'll talk to you next time.